for the pause and the break, and thanks for coming back and for our last panel, which will be very intriguing with private equity. So before that, I thought I'd give you a little bit of tidbits about 1988 that you may remember. A gallon of gas was 91 cents. Gallon of 2% milk, 189. Dozen eggs, 65 cents. That's pretty cheap. A movie ticket was $3.50. But you remember what interest rates were if you were buying a house back then? 10.5% to 11%. So we feel pretty good about today, don't you? Pretty good. All right, well, thank you again for joining us for the last of today's sessions. And we're going to be talking about private equity. And we have a really good setup for that on this. And we got a great panel, and it's going to be led by Audrey Kinsman, and she is the founder and CEO of Copper Trail Partners. And I actually know Audrey from organizations she's been involved with for many years. It's ACE Scholarship Funds here in Colorado, and I can tell you she's a great leader. She actually led our advisory board for a number of years, and she did a great job of leading that, so I appreciate that. As I mentioned, she is the co-founder and managing partner of Copper Trail Partners, LLC, an energy private equity platform based here in Denver, focused on direct ownership of minerals and working interest. Prior to that, she was a partner and senior managing director at Hain Anderson Capital Advisors, and before that, investment banker Goldman Sachs. So she has a ton of experience. She is a co-founder of the West Side Women in Finance and the former chairman of the board of advisors of ACE Scholarships. So I know this is going to be a really interesting panel, and looking forward to Audrey. She leads this with the rest of the panelists. So please help me welcome Audrey and her team.
Okay, can everyone hear me? I guess so. I think we're the last panel before cocktails tonight, so we hope it's going to be engaging and interesting and answer a bunch of questions that you may have regarding private equity and Colorado. Before we jump into the panel, there should be some note cards on your table. If you have specific questions that you'd like our panelists to address, please fill out those note cards, and some COGA representatives will pick them up. So today I'm very excited to have a very seasoned private equity panel in the energy space. Starting on the far side is Sam Holroyd, and she today is at Latana Energy. She has a very deep background in energy, in engineering, and in private equity and finance. I'll let her introduce herself in a second. In the middle is Peter Calamari from Platte River. He's the head of the energy services group there and has led the transactional efforts at Platte River for some time. And Kyle Kafka from NCAP. You've been there for the majority of your career and have seen a lot. But Kyle, why don't you start with giving us a little bit more about you and what NCAP's done in Colorado and
Sure.
the private equity world?
Thanks, Audrey. I appreciate it. And thanks to COGA for putting on this conference and for inviting me to come speak on the panel. Appreciate it. So NCAP, there's a big 1988 theme going on in the conference, and it dovetails perfectly to NCAP because NCAP was started in 1988. And so just as this conference was started in 1988, that was when NCAP was founded. Over the past 3 decades, NCAP as well has seen a lot of growth, and we've been an active participant in the North American energy space over the last 3 decades. NCAP's raised 21 institutional funds over that period of time, amassing about $37 billion from institutional investors. So we've been a very active participant. The core strategy at NCAP really centers around people and partnering with great management teams. And so we seek to go out and align ourselves with seasoned management teams in the industry and support them with equity capital to go find opportunity in the upstream and midstream space. They then use that equity capital to capture the opportunity, invest the capital to grow the asset from kind of an idea and a concept to something that's got a meaningful amount of cash flow and also has an opportunity set remaining that an eventual acquirer might be interested in further developing. And then we typically sell that asset or business to a larger company, typically a public company, who wants to kind of continue on with the asset and continue to grow it. Our involvement here in Colorado and in Denver has been pretty significant. We've invested in a number of companies in Denver over the 30 years that NCAP's been around. Currently, there are 7 NCAP-sponsored portfolio companies that are headquartered here in Denver. Those 7 companies employ hundreds of people and have invested literally billions of dollars across the North American energy space. Colorado, in particular, we have assets in the San Juan Basin in northern Colorado. We have assets in the Piceance Basin, and our most significant investment is in the DJ Basin, where we have both upstream and midstream assets and have invested hundreds of millions of dollars. So we appreciate Koga and what they do for the industry here in the state, and the efforts that they take to educate the population as to how important the industry is for the state, and appreciate being here.
Peter, can you tell us a little bit about Platte River and your experience leading the energy services team there?
Absolutely, thank you. And thank you again for having me today. Our firm is a little bit younger. We started in 2006. We manage about $1.5 billion, focused primarily in energy. And I joined there 11 years ago, shortly after the founding, to manage our energy investments. And unlike Kyle and NCAP, we focus on products and services companies. So upstream, midstream, and downstream. We've invested in frac sand, production, logistics, specialty chemicals for production, valve and pump manufacturing. Most recently, we invested in a company that repairs transmissions for pressure pumping equipment. So across the board, what we look for are companies that have a sustainable advantage. So high free cash flow, variable cost structures, unique market positions. We use less leverage than many other firms in our industry so that we can weather downturns, but also importantly so that we can invest in those companies through a downturn. And some of our most successful investments have been where we've acquired other companies or opened new locations in 2014 through 16 or in the prior downturns. In Colorado, we joke that we were happy to pay 10 to 20% premium for a company based here because we're just based in Cherry Creek. Unfortunately, we've only had a couple companies that have been headquarters here, but every one of our energy-related businesses has had operations here throughout the DJ and the balance of Colorado.
Great, Peter. Sam, would you give a little bit of your background? We've known each other since denim, but you've had a very technical, diverse background.
Yeah, thank you, Audrey. Appreciate the intro. And it's actually great to be here. I'm kind of a Denverite. I was raised here, went to Colorado School of Mines, so I have a technical background. And I've been fortunate enough to have been able to leverage a technical background and sort of evolve into more of a commercial side of the business. So I'm bringing a little different perspective maybe, and hopefully very complementary to how we're going to discuss investing and growth in Colorado. Where, my background includes over a third of my career with true E&P companies as a reservoir engineer, a third of my career in consulting and advisory with Ryder Scott Company, and then most recently, the last 10 years has been on the investing side in private equity. So I made a career change, if you will, about 8 months ago, and I'm now solidly planted with Lantana Energy Advisors. So now I'm sort of on the dark side, if you will, partially supporting an investment banking strategy, but I'm really trying to help out on the transactional side of the business, where I can leverage the technical background and help us assess asset valuations and then put those assets to market and try to match buyers and sellers. So my experience with Colorado, most kind of over the last 8 to 10 years, I would say focused mostly on our private equity investments here. Similar to Kyle's experience at NCAP, through some of my private equity experiences, we invested in the Piceance Basin and the DJ Basin pretty heavily. Through the course of my career at Denham, we had 4 portfolio companies headquartered in Denver, both on the upstream and midstream side. So I have had a lot of experience in investing here and comparing the experience with this and some of the other markets, and have always found Colorado to be a very engaging and supportive environment for oil and gas investing. Now I've moved into more of the transactional side of the business, where I'm supporting private companies and public companies in the transactional side. And so I wanted to maybe give you a little bit of kind of the tapestry, if you will, about transactions and how Colorado sort of fits in the range there. If we think about transactions on assets, and I'm primarily at this point talking about just upstream producing oil and gas assets, minerals packages, or development opportunities, Colorado for the past 5 years has typically done about 20 transactions a year. Now, our public markets don't always report the value of those transactions, so I can't tell you on average what all 20 did, but usually the market reports about half of the transactional values. And so over those 20, I know about the value of about half of those. So let's say on average, I know the value of 10 of those transactions. And again, over that same time period, kind of 2014 through 17, moving into 18, Colorado has historically been kind of a 20 transactions and $2 billion worth of transactions in the market. 2017 was a record year in Colorado, if you're not aware. You guys transacted, and this is only half of what was publicly available, but you transacted 30 assets in the state, public and private transactions, and you transacted over $6.3 billion worth of assets. So 2017 was a banner year. And the market throughout the lower 48 was growing as well. Over that same time period, we've seen growth in the lower 48. If I think about 2018 now, so what's happening now, the lower 48 is growing rapidly. From 2015 to 2018, the lower 48 is probably going to double in terms of total number of transactions and capital in the market. That's both some of the things you're seeing in the market. You're seeing public transactions, very large consolidations you're seeing, but they're also, and we'll talk more about that, there's a lot of private equity hitting the energy market, taking advantage of the downturn. Colorado has had its own unique perspective in this growth. The number of transactions for the first half of 18 is right on track. Transacted 11 transactions to date as of the end of July. So you're right on track to do the second half of 18 just as expected. There are 14 assets in the market today, oil and gas assets, trading, including minerals and producing assets. The challenge that I see, the one statistic I'm a little uncomfortable with, is the fact that through the end of July, we've only transacted about $500 million worth of assets so far. So we need a big run at the end of 2018 to sort of close the gap and get you back up to your average of sort of $2 billion. So we're all pulling for a lot of investment in Colorado for the next few months. And I think from my perspective, we're seeing a great deal of energy around the public markets ready to start to move some assets. They're continuing, I should say, through the last 3 years. There's been a lot of rationalization of their asset base. We're continuing to see that. We're seeing them cut a little deeper. We're seeing them go back to the public markets and say, look, we're going to put all of our capital, all of our free cash flow is going to be in our number 1 asset or our number 2 asset. And in order to do that, they're liquidating the second or third tier of assets. Many of those are sitting in Colorado. I spent the first day and a half of my time here in Denver this week out at Intercom, and there's a lot of public companies that have got some transactions coming on the market. So I think I think there's a great finish for this year, and I think the market for the buyers comes from the private equity and private capital investment here, and I think that's where the opportunity is.
No, Sam, I think that was great. And also, we talked a lot in preparing for this panel about historically, what role has private equity played in Colorado? I think we all agree that private equity has truly propelled the energy industry over the last 20 years to where we are today. And it's the reason we have such phenomenal success in economies of scale and production. And I'd say the entire shale revolution really started with investments like the private equity investments that all of us have made in. But when we look at Colorado, and you look back even over the last 5 years, we've tripled our daily production. We now went from 7th in the country as a state, as a producer, to now this month, the month of August, we are now number 3. We edged out my former home state of California, and we are now number 3. But it's amazing to think that Colorado is producing more barrels of oil than California today. And so why, I guess, is part of the question. Why, what have you seen from an IRR perspective, from an opportunity perspective? Sam, you laid out very beautifully the numbers of transactions, and the actual transaction volume here is nothing compared to places like Texas and North Dakota. So Kyle, sure. Why have we seen this tremendous growth? We're gonna jump into 97 and some of the regulatory elements of being a producer in the state in a minute, but can you touch on the private equity side?
Sure, yeah. I mean, I think that, all of us up here as investors, private equity investors, any kind of investor, when you're investing capital, you're looking to make a return, right? And I think that, a lot of the things you touched on with some of the, the industry as a whole, the shale revolution and the use of new technology to drill horizontal wells and horizontally frack them has really increased the economic opportunity set in certain basins in the country. And I think the DJ Basin falls squarely in that category. And the opportunity to invest capital there and go make a good return through the drill bit has been really tremendous. So I don't know how the growth in the state's production breaks down, but I would imagine that a pretty big portion of it's coming from the DJ. And I think that the opportunity set there to be able to go invest $1 and turn it into $2 has been really good. And that has naturally driven investment towards the basin. Since you brought up California, I think that, the reason that it's displaced California is because of California's regulatory environment, right? I mean, there are great basins there with lots of oil. It's historically been a very, prolific place to produce oil and gas reserves, but over the last decade or two, the state has made it very, very hard to go there and invest in the business. And I think that, as investors, so there's less people investing in it. There's less opportunities to exit because there's less companies that want to buy assets in California. And so as you think about putting an investment there where someday you're going to have to monetize it, when you've got the exit in mind, it's harder to think about putting dollars there.
So one thing I've heard quite a bit from our operating partners here in Colorado is just the efficiencies on the services side, super pad drilling, phenomenal growth in frac technology. Peter, what are you seeing in the services side and in the technology side of energy, and how is that impacting Platte River's either view or investment in the next stage of growth in those technologies? Have we hit a plateau, or is there a lot of room to go?
So if you break it down into a couple of pieces, you had maybe 3 pieces. You had coming out of the downturn, the service companies took it on the chin with pricing and operated at break even, maybe slightly below. And that was one big source of operational efficiencies that drove down cost and allowed operators to continue drilling and completing wells. We've seen a massive increase in deployment of technology on 2 sides. True technology, data analytics, better frac designs and alike. The side that we've spent more time on is, we would put it under technology, but more things like regional frac sand, where you're saving tens and tens of dollars a ton by removing the logistics costs of the rail and some of the trucking by having mines located, and we actually just permitted our first mine in Colorado, which will have a big impact on the state as that proliferates, as it did in the Permian, where we were early investors in that area. You're seeing it on, now we're seeing it on the maintenance side. There's been a huge increase in maintenance costs as operators have gone up, so investing in areas that help the operators reduce maintenance And so we'll see more and more of these. So I think every plateau, the operators, the NCAPs, the private equity investors of the world have been able to find new sources of cost savings out there, and I think that'll continue to propel break-even costs down in the industry further. So for us as investors, we have to look for businesses that are helping their customers achieve that. If we look for companies that are just the status quo, we'll get run over. So finding those companies that are really ahead of the game and working with their customers is really where we need to be.
Great. So obviously 97 is something that we're all talking about. And on the transactional side, as we manage our own businesses and our portfolio companies, we try to understand and really corral risk. And as private equity investors, a major element of our business is the ability to take risks and identify risks that are worth taking that maybe the public markets don't. So, Sam, when you think about 97, the potential impact of setbacks, how do you either quantify it or think about the impact to your clients on the transactional side? And then I'd love to hear both Peter and Kyle your opinion on how 97 factors into your investment thesis, both with your existing companies in the basin as well as with your investors and your GP around the GP at NCAP and Platte River. How do you think about the regulatory risk?
Yeah, so I'll start on that one. We're continuing to see a lot of transactions in Colorado, as I mentioned previously. From the private investors, if you're talking to the institutional investors as a pure private equity, you are seeing a little bit more caution, shall we say, around the uncertainty of I think, Proposition 97. And I would actually describe that more as an uncertainty than I would call it a true risk, because I don't think anyone can quantify it yet. We've met with a number of political specialists, and we're trying to understand that from our lending perspective. So we have a full commercial investment banking platform as well, and we're trying to understand that from our capital investment on the debt side. And really, we're seeing such a low probability of Proposition 97 making it all the way through the multiple steps that it has to cross, that we're thinking about it being a different animal, if you will, when it finally, or if it finally does get to a full resolution. So from our perspective, we're trying to encourage folks to have a long-term view as opposed to a short-term view. We are encouraged by, especially in some of the more interesting development trends, DJ Basin, we're encouraged by the ability to have some development activity there continue on. Obviously, the production base is available to continue on. And so I think there's a lot of caution in the sense of don't be reactionary. Don't stop investing in Colorado. Just be a little bit more thoughtful on how you enter and how you build mitigation into a longer-term view as opposed to thinking of it as a 2 or 3 year exit.
Great. Either one of you?
Sure. I think that it's obviously, as I mentioned, we do have a significant amount of capital invested in Colorado. It's been we also love coming to Denver, always looking for more partners here in Denver. It's a great place to come, especially when it's 105 degrees in Houston in the summer. We do think of it, we follow it, and sometimes when we think about risk management, especially a risk that you can't totally quantify the outcome, one of the ways that we manage risks is through exposure, right? And so if we're looking at, forget Colorado for a second, but if we're looking to go into an area and pick up some acreage and go try to prove up a new concept where there's not a lot of existing data, we think about that in terms of, okay, how much exposure do we want to that before we know what the outcome's going to be? And we try to limit the exposure to an amount of money that we think is palatable for our company or for our funds, and that if it doesn't work out, we can still kind of live to fight another day. And, I think I would describe it as that because, to your point, it's a risk it's hard to quantify. Prop 97 probably won't be passed in this exact form, but clearly there's a political environment here that there's some risk that, it becomes less friendly towards the industry. And so I think as we think about our exposure level, it's probably not somewhere where we want to expose, 100% of our capital, and we want to make sure that we're watching how much is exposed.
Right. Peter, do you could.
Along the same lines, we think about the diversity. So would we put 100% of our capital in one state, one basin? No, we try to make investments where we have exposure to multiple locations because there's lots of risks or uncertainties like this out there. If you look at the Permian today, you're having huge impacts of congestion and logistical challenges that might not have been foreseen, or oil prices could fall in half. So there's a multitude of risks that we keep an eye on and want to be cognizant of, but ultimately we try to be diversified in where our companies are, where we're making investments to make sure we can survive any of those changes. Obviously, personally and professionally, we hope that the environment continues to be friendly here in Colorado. But we also want to make sure that we have not all of our eggs in one basket.
Do either of you get pushback from your LPs on Colorado? Does it come up? I mean, our business is mostly focused in Colorado, but we're small. And it's part of the thesis. But you have diversified private equity funds that are multi-generational funds. So what's that dialogue like when you talk about your exposure here?
I would say that we don't typically have a lot of that dialogue. The LPs are, obviously it's a broad LP base, and there's different levels of in-tuneness or sophistication with the energy business. Some of the investors are pretty generalists, and it's a little bit of a nuanced thing going on in the industry. It hadn't been a focus of our LPs of late. And again, it's from a diversification standpoint that we're talking about. It's a piece of the portfolio.
I might add to that, if we all kind of roll the clock back 3 to 5 years, in another state, in another time, Oklahoma went through a very similar experience where fracking started to become something that was very much in the public eye and something that very much was focused on at the regulatory level. And at one point, I know we were talking with all of our portfolio companies about what are you going to do, how's this affecting, and it was a matter of patience, and it was a matter of, again, knowing that you're diversified as an investor, you're able to weather some of those storms, you're able to work through those. My experience in terms of raising capital, we didn't have any of our LPs pull the plug on a commitment because they decided no, they didn't want to, go into Oklahoma because there was an uncertainty around fracking. So I think patience and just kind of having, again, that long-term view is the key here, and knowing that you're not the only state who's gone through kind of this recognition of some of the risks and the realization that you have to sort of close the gap in terms of expectation on investors, expectation on producers, and what the environment wants.
Have you seen any of the, the dueling characteristics of phenomenal IRRs, great performance, technology increases, making it really attractive to be an operator here, and then the regulatory front, making it much more challenging than operating in Oklahoma? Have you seen either of those, or have you seen those factors impact your lending or your ability to borrow, or the lending universe in general?
I mean, I think from speaking from the products and services side of the energy market, there is still a real reluctance for lenders to engage. And I think there were enough losses in the lender community from the oil field coming out of the last oil and gas recession that they haven't yet wanted to come back into the market. So for investments that we are pursuing today, they are highly equitized. And knowing the lending market, they'll get aggressive right before the next downturn comes. But so it has been a challenge for us. I think it keeps the lid on valuations. I think it makes it challenging for a services or products related company to sell. We believe it's a good opportunity, as we've seen 18 months now of strong performance and a stable to positive outlook going forward. But that's just speaking from the general leverage loan, private equity, services and product side.
Yeah, I would say from the E&P side, similar to Peter's opening comments, we try to take a very conservative approach to leverage across the portfolio. It's a cyclical industry. It's a habitual consumer of leverage, but we feel like by keeping a low leverage profile in our portfolio companies, we're well positioned to play offense if and when the inevitable cycles do come. And so we don't have a lot of leverages in those businesses, but I would say we hadn't seen an impact where they want to lend less to assets in Colorado.
Okay. So we talked a little bit about what's going on right now. What do you see as the biggest opportunities for private equity in Colorado going forward? When you look just across the landscape, I would say maybe a pre-November 6th answer and then maybe a post-November 6th answer.
Wow.
No one wants that question. Sorry.
I mean, I'll take a stab at it. I mean, I think that, again, if you're willing to take risk, right? I mean, I guess there's an opportunity to go invest in these assets with a view that there won't be additional regulation, and you'll be able to realize the strong returns from the assets. And when that risk is eventually taken off the table, the value of the assets will go up. Obviously, there's a risk there that if there is additional regulation and if some form of setback rule does get passed, then a portion of your inventory could either be devalued or I think maybe more likely be tied up in some type of prolonged fight that makes it hard for you to go really develop the asset over a reasonable period of time and realize a return in a reasonable time frame.
And I might build on that. We have in our audience today a lot of business leaders, your CEOs of oil and gas companies, your leaders in industry, in services, in providing services to the oil fields and the oil and gas companies. What I would love to see is your continued voice that you're going to continue to invest in Colorado. I think one of the worst things that can happen through this transition and through this evolution would be for us to look into the magnifying glass of Colorado and have some of the local investors say, no, we're pulling back, we're pulling our capital out, we're diverting. And I think what we're seeing from the outside is that we do see you guys continuing to grow your businesses and continuing to invest locally and continuing to build on your development plans. If you go to some of the press releases from the publicly traded companies, you'll find out that those companies that are operating in the DJ and in the Piceance, they are actively pursuing technology increases. They are delivering on improved IRRs in their wells through longer laterals, through better frac technologies. You'll also see a lot of midstream optimization addressed both in terms of localized development in the DJ and then if you move west towards the Piceance. So I think what's great is that if you just continue to invest in yourselves, I think you solve a lot of the uncertainty and the risk that outside investors may see.
That's great. So I'm supposed to take some questions now. If anyone has additional questions they'd like to offer, I don't know if there's any note cards or if anyone in the audience just has a question for the panel. Yeah. No additional questions. Would each of you like to just have some closing remarks? So I'll repeat the question. The question was, as investors in Colorado, do we see the above ground risks, whether it's pipelines, regulatory, or services, as a greater risk than the below ground subsurface reservoir risk of Colorado? It's a great question.
Yeah. I'll take a stab at that. I mean, I think it depends on where you are. If you're in the, Core Wattenberg in an urban area, I would say that the below ground risks are relatively delineated and known and are lesser, and the above ground risks are greater. If you're going into a rural part of Colorado to drill an exploration well, then probably the below ground risks are greater.
Agreed. Yeah.
if there's no other oh, yep. Sure, so I'll repeat the question. How do you think about the management teams you back, essentially, whether it's putting it together, backing a team, more of a general private equity, and all three of you have had experience backing private equity, or management teams in private equity?
I mean, I think it's a terrific question, and in many ways, we've become an HR organization, not necessarily an investment organization. And so in the last 10 years, we've evolved from meeting a management team, and we're backing existing teams, but meeting a team and making a judgment on them personally, that was sort of the model 10 years ago, to today. We will do assessments, which will have several parts to each manager. That'll include an organizational assessment on how they interact and how they manage. We'll do 10+ reference checks on the key managers that we're backing, and we'll work hand in hand with them, getting them mentorship and all the resources that they need post our investment to make sure they're effective. And then we'll work aggressively to upgrade or replace or fill in gaps on that team post-closing. And that it probably takes, whereas it might have been 10% of our time, and if you had a manager who wasn't performing, you would work on replacing them. Today, that's probably 40% of our effort, is identifying, backing, developing the right managers.
I think what Peter said was perfect, because he told you how the evolution of our business in terms of private equity and how we think about managing or if you will, developing management teams. I remember when I first got into the investing side, and I was the only technical person on the platform, and the CEO of our investment firm called me into a meeting. We were meeting a new management team, and we walked out, and he said, "What do you think? Do you love them?" And I said, "Well, I have this uncertainty about one of the guys on the team," and he happened to be a core player because he was the operations manager, would have been a COO, would have been in charge of drilling all the wells, making sure we met our budgets in terms of all the development activity. And it was hard for me to articulate why I wasn't sure if he was the right guy. And the best way I could explain it to him was, early in my career, I worked for a large E&P company, and I remember being an engineer in office number 3, and there was an engineer in office number 4, and an engineer in office number 2, and I remember thinking to myself, well, last night the guy in office number 3 took, phone calls all night on a tough drilling operation, blah, blah, blah. Well, I knew about that, so the question I asked this CEO was, are you the guy who took the phone calls in the middle of the night early on in your career or while you were working at an E&P company, or were you the guy in the office next door? And that subtlety makes a big difference. And I think what Peter told you is we're diving a lot deeper into the background, not just what you've done, but how you did it, how you interacted with all levels of the organization, and to make sure that we have the competencies, not just that they know what to say, but they've actually done some of those things.
I think it's a great question. Also, I'll add a little bit in that, typically our management teams come to us relatively consolidated, and so we don't typically try to grab, 5 different highly skilled people and put them together to create a team. A lot of times there might be a gap or 2 that are filled later, but usually the core team is there, and they've kind of got a concept and a business plan and an idea that they believe in, right? We think that if we are the ones telling management, hey, there's an opportunity over there, or go do that we're not doing it right. We're trying to partner with people that have a lot of experience in this business, understand risk, understand economics, and have a vision on where they want to go and why they think there's a great opportunity there. And then we want to talk to them about that a lot and understand it and embrace it. And so we spend a lot of time with that management team. We like to call it dating, before we get married, to make sure that we fully understand where they want to take the business, why they think there's an opportunity there, how do they think about risk, how do they think about economics, and we want to make sure that we see the world similarly, because the last thing that we want to do is sign on the dotted line and then, the first project that they come talk to us about is, drilling wells in Alaska, and we're like, well, we don't want to do that. So, we try to have a lot of dialogue up front about where we think the opportunities are and make sure we see eye to eye.
That's a great question. So our final question for the night, thank you, Matt. What emerging trends do you see in private equity energy that you think are going to change the business in the next 3 to 5 years? It's a great question. I know we talked a lot before this panel about the trends that really got us here and how things are evolving. But when you look forward, what do you think globally is going to change? And I would add that there's $50 billion of dry powder in energy private equity. I mean, there's been a massive amount of capital raised.
I think that's a big trend that we're all seeing right now, right, is that if you look, compare today to 10 years ago, there's a lot more capital that's been raised in the space. So there's bigger dollars to put to work. I think that you've seen private equity come in and play a more meaningful role as the acquirer in the A&D side of the business lately, as the public capital markets have been focused on operators drilling the assets they have and kind of proving that they can make a return. Assets that have come to the market have been more and more purchased by private equity. And so I think that, we may be seeing private equity move into a phase to where, they used to grow assets from here to here, and maybe they're going to participate in a more meaningful way and more of the, early to mid life cycle of some of these assets versus just the very beginning stages.
So less of a land play, more of an operations.
Definitely a big focus on operations right now.
And that definitely changes the both amount of capital and the duration of your investment.
Absolutely.
If you're looking at that. Peter, Sam, what do you see as the trends coming down the pike for private equity in the next 3 to 5 years?
So on the internal side of private equity, the abundance of capital has increased valuations, it increases competition, and so it forces firms like ours to reevaluate everything we do and how do we get more effective and how do we add more value. So I think you're seeing us and other firms looking at investing in more and more resources, whether it's how do we help accelerate new product development, how do we help accelerate new technological development, how do we be more aggressive on acquisitions, and so on and so forth. So a lot more investment in our firm and the resources that we can bring to bear. In our companies, I would say every business we read a book on today is somehow being rebranded as part of the Internet of Things and having massive technological exposure. And a lot of that is smoke and mirrors, but the reality is from the investment bankers. But the reality is we do have to invest in all these areas, and we're seeing more and more of our customers demanding us to have software that integrates with theirs, the ability to add more value to them to remain competitive. And so we do look for management teams and companies that are innovative and aggressive and passionate about their businesses and how to drive them forward.
So growing into new areas that weren't really part of the equation a couple years ago.
Yeah, we used to take almost pride in saying we invest in companies and sectors that just don't change, and that afforded us a level of stability. And in the last 5 or 7 years, that's really been flipped on its head, that energy, rail, transportation, all these sectors are really embracing new technology, which is really makes it very exciting.
Yeah. Sam, anything to add before we close it up?
I would just kind of build again on what Kyle said. We are definitely seeing a shift in how private equity invests in all oil and gas opportunities. Where they're moving from the land grab into buying an asset and developing or expanding the asset. With that, and thankfully we do have a lot of dry powder in the equity markets, but with that will become this extra burden of scale. And so I think what you're going to see is previously when a private equity company was granted a $100 to $300 million commitment, and they could take that and they could buy something very organic and grow it. Now they're having to step in at a higher level. They're having to buy in at 300. They're having to really grow. They're having to really execute on acceleration, which is where a lot of the value is on these development plays. And so the drain on capital, the need for capital, I think is going to continue to increase. And so I think it's great for the business and a great opportunity.
For joining us for the private equity panel. I'm honored to be the moderator with Sam, Peter, and Kyle. They are people I've always looked up to in the business, so excited to be here. Thank you, Koga, for inviting me to moderate and for hosting an event to focus on Colorado. I think it's about time for cocktails after a few announcements.
1 minute. Thank you all very much.
Thank you.
Round of applause. Yes, thank you, Samantha and Kyle, Peter, and Audrey for that great panel. What a day. Thank you all for staying with us throughout the day. We started the day in the DJ talking about infrastructure. We talked about culture change and how to create that winning environment in our companies as they constantly change and grow. We heard from author Robert Bryce, who told us that our industry supports modern life and that we should not apologize for that, but we should be prepared to fight for it. And then in that panel, we just took a deep dive into private equity. And throughout the panels, throughout the day, you heard a little bit about Initiative 97 throughout those things. It's something we can't avoid talking about. We had a reporter contact us today asking some questions, and he said he feels like there's a gray cloud hanging over conference because of Initiative 97. And I certainly hope that you don't feel that way. I do not have a gray cloud hanging over my head about this, and I hope that you don't either. We're going to talk about this election tomorrow at 4:15 in our last panel, and I hope that you all join us there. We'll talk about what's at stake and what we all need to do to be engaged and to fight and support our industry in 2018. So do not let a gray cloud hang over your head. And in fact, to show that there's no gray cloud, we're going to go have a party now. Our opening night party begins right now at 5 o'clock at the Ellie Calkins Opera House just down the street. Again, it's a trip back to the 1980s. If you weren't in the 80s, hopefully you'll enjoy it. If you were there, hopefully you'll recall some of the music and different things that you're hearing there. If you don't have tickets, you can purchase them on site. Party starts now. If you do go, don't have too much fun because we'd like to see everybody back here at 9 o'clock tomorrow. If not, we'll see you back here 9 o'clock. Our first panel tomorrow is an executive forum on urban development and how to be a better neighbor. So again, thank you to all of our sponsors. Thank you to our exhibitors. Thanks for all of you for being here today. Hope you had a great day. We'll see you tomorrow.